Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
This podcast was recorded for publication on the 12th of June 2025 by HSBC Global Investment Research. All the disclosures and disclaimers associated with it must be viewed on the link attached to your media player. And remember to like and subscribe to Under the Banyan Tree wherever you get your podcasts.
Hello and welcome to Under the Banyan Tree, where we put Asian markets and economics in context. I'm Fred Neumann, Chief Asia Economist at HSBC Global Investment Research.
And I'm Herald van Linde, Head of Asian Equity Strategy. On the podcast today, we're looking at how Asian investors are viewing the US right now.
That's right, plenty of volatility. Obviously, the Donald Trump-Elon Musk spat is dominating headlines as we record this. But there's a lot more to think about in terms of the US dollar, market dynamics, and growth.
What does all of this mean for Asian investors and where they're putting their money? Let's kick off the conversation right here under the Banyan Tree.
So let's take a quick look at the big macro picture and some numbers here. So if the U.S. imports capital to fund its budget deficit, and it borrows from the rest of the world. Now, last year, the U.S. accounted for 62% of all global cross-border borrowing. That is an enormous amount. Now, and then on the other end, you need to look, where does this money come from, right? Which countries lend to the United States?
Yes.
And you always think, well, China is one of the largest ones because of big excess savings. But actually, China is only the second largest, accounting for 14% of cross-border lending into the world economy. The largest one was actually Germany.
I was going to say
16%.
I was going to say, can I make a guess here? I thought that might be Germany. That is right.
So,
because these are current account surplus countries. These are countries where there's more savings than investments. They are providers of capital to the rest of the world.
Yeah. Yep. And so just to add some numbers, so we have Germany 16% of total lending. We've got China 14%. Then you have actually Japan at 8%.
Okay, so much smaller. So we're talking about give or take 38% of total.
38%. Then you have the Gulf countries.
Okay, yeah.
About 7%, slightly smaller than Japan. And then, Harold, what's the next one?
Don't tell me
6%.
it's the Netherlands.
It's the Netherlands.
Oh, my goodness.
The Netherlands
That's what I thought
is among the biggest providers of capital to the world.
Yeah. Now, so it's these countries that account for about 50% of where the U.S. borrows from, give or take.
Yes. Yeah. And then you can add the smaller Asian economies, of course, Taiwan, you get Korea, you get all emerging markets, and in Europe as well. Actually, there are other economies in Europe that are big savers. In fact, Europe overall is the biggest lender into the world economy. And now, what does this mean? When we think about foreigners being less willing to hold U.S. bonds, for example, they sell these bonds, and where do they put their money?
They go back home.
They go often back home, yeah. And so that means a lot of money has gone back into Europe, actually.
Yeah. European money probably goes back to Europe.
European money goes into
Europe.
Europe.
And Asian money goes back to Asia.
A lot of it goes into Asia. Some of it goes of course,
into
Europe.
Yeah.
But that's right. There's a home bias. And that's why you see some of the receiving currency suddenly doing better because as money is coming home. The euro has done better against the U.S. And so you see some of the Asian currencies doing better against the U.S. dollar.
The yen has strengthened a lot, yes.
That's right, yeah. Now, you could say that's just temporary, money flows in and out and then ultimately destabilizes, then there's not a big difference. But if this is a permanent shift in the way investors allocate their money, and there's some indications it may be a bit more permanent, then that has economic implications. I wanted to ask you about this because one way to think about this is that if we lend less money into the U.S., the cost of capital in the U.S. goes up because there's
That's
less
the higher bond yields.
higher bond yields.
Yeah, because you need to make it more attractive for people to come and give you money.
That's right. It's not just the government, right? It's also the companies that borrow in the credit market that will have to pay higher interest rates because because government interest rates are higher, so corporate interest rates are higher. Ultimately, that also would mean that the cost of equity capital goes up, partly because I guess there is,
Yeah, there's a spillover effect. So the cost of equity goes up. And net, that would be negative for equities in the US. But it's not the only driver of stock markets because you also have growth. So basically equities are growth and the cost of equity, as we call it now, interest rates. So interest rates go up, that's negative. But if your growth goes up, that's a positive. And net, that could still mean that markets can lift up. And that's, I think, what we've seen over the course
we have
over
up
the last
until
1 or 2
now.
months.
The question, of course, is do you see growth going up permanently if the cost of capital goes up permanently?
Yeah.
There could be an impact.
That is right. And so that means that growth could slow. But the opposite could, of course, happen here in Asia because your cost of capital goes down, money comes here, and that allows people to borrow at lower rates than they would normally do and therefore can maybe invest a bit more and your growth can therefore go a bit higher, right?
And so my question to you is, because you look at the corporate funding world quite a bit, does that then confer a permanent competitive advantage to Asian companies in the long term? Because if you have an Asian company that can fund itself even cheaper, an American company that suddenly faces higher funding costs, over a period of 2, 3, 4, 5 years, that would certainly mean that Asian companies have a competitive advantage then, don't they?
It is a competitive advantage because your access to capital is improved. So if you want to grow, that's good. But for a truly competitive advantage, you need to have other elements as well, which is innovation, brand recognition. People want to like your product, these sort of things, maybe industry consolidations. So it's in those particular pockets where these things all play together, where you can probably find interesting sort of equity stories unfolding, where industries that really consolidate, where they're innovative. Think about EVs, for example. This got a lot of attention in Asia for exactly those reasons. And those are sometimes Chinese companies, so the Chinese story is slightly different because we spoke about this in previous podcasts as well, there's an enormous amount of capital that's locked up in China, but it's also for other companies across the region, of course. It's easy to get access to capital, and if you're innovative, you get an interesting product to build. Think about some of the semiconductor companies across the region or branded goods. Yeah, they're in a very good position in that sense to grow their business.
I think that's fascinating. One issue we also often hear, though, against this idea that there's a permanent relocation of capital from the U.S. into other parts of the world is that there is just not enough assets to buy in the rest of the world. And that means that investors have no choice but to leave some of their money in the U.S. But maybe that's something we can discuss when we come back. We'll look further into asset diversification out of the U.S. Okay, well, back here, folks, and we're just talking here about diversification of money out of the U.S. Yeah, right. But here, Harold, one thing we often hear is that investors saying, look, I got all my money or a lot of my money in the U.S. Maybe I like to buy something else because things are getting a bit, volatile over there. Yeah. But there aren't really that many alternatives. And so there's a limit to which Asian investors can really sell U.S. assets and go somewhere else. Is that right?
Well, yes and no. So for small investors like you and myself, if you have a few dollars to move, you and I can buy Bangladeshi equities if we want, right? Or we can go to Vietnam or whatever. But if you are a very large investment fund and you got a couple of hundreds of billions of dollars to reallocate, then the story is completely different. You can't go to certain markets simply because there's just not enough for you to buy. Very simple. So in global equities, if you just think about it, it's well over 100 trillion, 120, 130 trillion US dollars of capital in there, but about 45% or so is the US. The rest of the world is just a little bit bigger than the US almost alone. China is a big part of that as well. So there's only so many markets where you can take money from and move from those. So that's a bit of a limiting factor. That's right.
That's right. And I think that's sort of kept some investments in the U.S. There's a sheer scale, the liquidity, the ease of transactions, and so forth.
It remains an incredibly innovative place as well.
It is, yes. But then also as an economist, we know that the demand tends to create supply. Ultimately, when there's demand for assets
the
for
law
outside,
of say, I think. as an
No,
economist.
that's the other way around. Every supply creates its demand.
Demand. Oh,
No,
yeah, that's
you're
right.
confusing
Yes,
our
yeah.
listeners. It's really this idea that if there's demand for a product, ultimately the supply tends to expand because there's an incentive to produce that. Now, we tend to think of this in terms of dolls or cars or semiconductors, but here the idea is if the global investment community really wants more non-U.S. assets, which are limited at the moment, over time, if that demand stays, there could actually be an incentive to issue more of those assets outside of the U.S. I mean, a very simple example would be interest rates go lower in Asia because of money coming back, and that means governments can issue more debt, so the debt pool expands. And similarly with equities, if there's demand for equity markets, equity assets in Asia, then there's incentive for IPOs, right? And there's incentive for bringing more to the market, isn't it?
So first of all, it would be cheaper for companies to expand the business. So if you want to build another plant, it's now cheaper to do so. So there you go. That's you grow your business, and so you can do a rights issue, for example, to obtain that capital as well. And of course, we see in certain parts of Asia the IPO markets reviving. In particular, Hong Kong has seen quite a few IPOs, and it looks like the pipeline is quite busy for the remainder of the year as well. So this IPO market is coming back. But there are markets in Asia where we need to see more IPOs, I think, as well. ASEAN in particular. These markets are still small and narrow. So there's a few large companies there that people typically invest in, and then it's getting too small for them. So we need to see more of these sort of companies coming there. And that sometimes it's regulatory, very difficult to list, or it's quite an onerous process, or these sort of things.
So the most liquid and deepest equity markets in Asia would be mainland China, Hong Kong?
In terms of size and liquidity, mainland China is very big and very liquid, and Hong Kong fits into that as well. India and Japan come up very closely together.
And how do they compare? The neck to neck, would you say?
India is quite sizable, but it's fairly liquid as well. So that's an issue. Korea and Taiwan are a bit smaller, but can also be fairly liquid. And then you have the ASEAN markets, which combined are still small and not so extremely liquid. So it's more for specialist funds that typically go there.
And we talk a lot about the Hong Kong market, for example, and it's been one of the key Asian equity markets. There's been a lot of talk about more IPOs coming here, which would expand the market. Is that something that is likely, and is this driven by this demand by investors not necessarily as being as keen on U.S. assets?
Well, there's a couple of things going on. First of all, you have what we spoke about in the past, the homecoming sort of process. So we've had over the last, say, 5, 6, 7 years, a lot of Chinese companies listed in New York, relisting in Hong Kong. Technically, they make this the primary listing eventually. So this is where they raise most of the money. And most of the trade is taking place. We see new companies coming to the market as well. So there's quite a pipeline. Because for the last couple of years, it was difficult to do so. So companies that planned to do so couldn't do so, or felt it was not a good time to do so. But with the market reviving, that is coming back. And the pipeline, as I mentioned earlier on, is pretty strong. So in Hong Kong, this is very vibrant. We just need to see it in other parts of the region as well. But this will help out.
So there you have it, folks. I guess, Harold, there is still some life left in Asian markets. So it means we might still have a job in the next few years.
We might still have a job, or at least looking at markets is continuing to be very exciting. And it's important to understand that this is driven not only by the US dollar, because that's an ongoing process, but also simply by the dynamics that we have in the region here, the growth, the investment, the leadership in certain technologies that Asia has, that is driving that. And that money now coming back is enabling these companies to flourish even better than they've done in the past.
So a rebalancing of the world economy, not just in trade and investment, but also in financial markets.
Absolutely.
Well, we're going to have to wrap it up here, folks. A pleasure to have you with us as always. And do give us a like and subscribe if you haven't already.
Under the Banyan Tree is an HSBC Global Investment Research production, as is our sister podcast, The Macro Brief from London. Do give that a like and a listen to. From all of us here in Hong Kong, take care, and we'll talk to you again next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.